If you think you need thousands to start trading, listen carefully. You've been lied to. One of the most common questions beginners ask is, how much money do I need to start trading? You'll hear all kinds of answers. Some people say you can start with $10, others say you need thousands, some say you shouldn't touch the markets unless you're well capitalized. But here's the truth. The amount of money you start with matters far less than how you manage it. Today, we're going step by step through exactly how much capital you need, how to use it properly, and what account size makes sense for your stage of trading. And by the end of this video, you'll finally have a clear, realistic roadmap for starting the right way. The myth: you need a lot of money. Most people believe trading is only for people with large accounts, people who can drop $2,000, $5,000, even $10,000 into the market without thinking twice, but that's simply not true. In fact, starting big often backfires. Think about this. If you give someone who has zero discipline a $5,000 account, they'll blow it just as fast as they'd blow $500. The only difference is the level of pain. That's why the real secret isn't capital, it's discipline, risk management, and patience. A $200 account with discipline is more powerful than a $5,000 account with chaos. Why? Because someone with discipline limits risk, trades less, follows their plan, avoids impulsive decisions, respects the market, manages emotions. Someone without discipline does the opposite, no matter what their account size is. They assume a bigger account automatically means bigger profits, but if you don't understand risk, a bigger account simply means bigger losses. Give two traders the same $1,000 account. One has a plan, grows slowly, one follows emotions, burns it in days. The account size didn't matter, the behavior did. The myth that you need a lot of money to start trading only exists because people misunderstand what trading really is. Trading is not about hitting home runs, it's about consistency with whatever capital you have right now. What you actually need. Let's break down real, practical account sizes for beginners, and what each stage is actually meant to accomplish. 1. Absolute minimum. $0. Use a demo account. This is where true beginners should start. Not because demo trading feels exciting, but because it teaches the basics without risk. How to place trades. How stop losses work. How leverage affects position size. How to navigate your platform. How to read charts. How your emotions react to wins, shots, or losses. And here's the thing most educators don't tell beginners. Demo trading isn't about making money, it's about building skill. You should stay on demo until you can, at least, follow a consistent setup. Avoid emotional overtrading. Maintain discipline, not for a day, not for a week, but over many trades. 2. Beginner live trading. $100, $500. This is the stage where you start feeling real emotion, and emotion is the hardest part of trading. $100, $500 accounts teach you what fear feels like, what greed feels like, the urge to over-leverage, the frustration of slow growth, how it feels to lose your money. This stage is not about getting rich, it's about learning how you behave when real money is at risk. If you can manage a $200 account with discipline, you're already ahead of most people trying to force fast profits. 3. Serious beginner growth. $500, $2,000. This is where the mechanics of trading start making more sense. With a slightly larger account, you can position size more safely. Spreads and commissions matter less. You avoid micro account stress. You start thinking long-term. This stage helps beginners understand the power of small, consistent gains. 4. Scaling trader. $2,000, $5,000 plus. This is not for beginners. This is for traders who already have consistency. With a larger account, your discipline is tested even more. Losses feel more significant. Gains become more meaningful. Emotions amplify. The obsession with being right gets stronger. What most beginners don't realize is this: moving to a larger account does not make you a better trader. It simply exposes who you already are. The real key: risk per trade matters more than account size. If you always risk 1% per trade, then $100 account, $1 risk, $500 account, $5 risk, $1,000 account, $10 risk, $5,000 account, $50 risk. It's the same percentage, which means the skill set stays the same, only the dollars change. But most beginners don't want to hear that. They want fast money, they want shortcuts, they want a big account, without big discipline. And that brings us to the mindset shift that changes everything. Growth mindset versus get rich quick. Let's call it what it is. Most beginners want to turn a $200 account into $20,000 in a year. It's not impossible, but the people who achieve that level of growth spent years learning discipline before they ever hit those results. The truth is this: a small account is not supposed to make you rich. It's supposed to make you disciplined. Your first account is a training ground, a testing field, a place to fail, safely. Because here's what the market really rewards: consistency, patience, risk awareness, emotional control, database decisions, not hype, not gambling, not lottery ticket thinking. If you can manage $200 with maturity, then you can manage $2,000. And if you can manage $2,000, you can manage $20,000. Skill scales. Impulsiveness destroys. Once beginners understand this, their entire approach to trading changes. The smart way to grow a small account. If you're starting with a small account, here's the correct way to grow it: slowly, safely, and sustainably. 1. Trade one setup only. This eliminates noise. You master one thing deeply instead of 10 things poorly. Examples of simple beginner setups: break and retest, simple trend continuation, basic support, shear resistance bounces. When you only trade one setup, your brain becomes incredibly good at recognizing quality. 2. Withdraw profits monthly. Even if it's only $20, even if it feels small. Withdrawing teaches you two things. Trading is a business. Profits aren't meant to sit exposed in the market. This keeps you grounded and prevents the "I need to double my account fast" mentality. 3. Increase position size. Only when consistent. Many traders scale too fast. They jump from risking $1 to $10, or from $10 to $50 because they had a good week. That's how accounts blow. A trader who slowly scales will always outperform the trader who tries to get there faster. 4. Track your win rate, and risk-reward journaling might feel boring, but it's the most powerful tool you have. When you track your trades, you start seeing patterns. Where you win most, where you lose most, which setups work, what time of day you struggle, what emotions trigger bad trades. This turns trading into something predictable, not random. A small account becomes a laboratory for building the habits that will support you when the money gets bigger. So, how much money do you really need to start trading? Not much. What matters isn't the size of your account, it's the size of your discipline. Start small, master your emotions, follow your plan, and let your skill set grow before your account does. Because consistent traders always win in the long run. And if you stay committed, you'll become one of them.